Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending December 2nd, 2022. Looking at the market indexes for the week, the TSX, S&P 500, Dow Jones, Nasdaq, and Russell 2000 were all up significantly for the week. Oil was up past $80 per barrel, and gold was also up, possibly as a safety play from the continuing issues in the crypto industry. Looking at Canada first, the Canadian economy's GDP grew 2.9% in the third quarter, far exceeding the 1.5% expected. This is a great number, much stronger than expected, but could also cause further interest rate hikes since the Canadian economy is still strong and the labor market will remain tight. Canadian real estate is coming down, and this is influencing Canadians more than Americans because our economy is tied closely to the Canadian real estate. And our interest rates probably won't need to go up as much as in the US because of the slowdown of the Canadian economy due to real estate. People have less money to spend on other things because they are spending more on their real estate holdings. The Canadian interest rate, currently at 3.75%, will likely top out in the fours and not go into the fives like the US. Canada is more sensitive to interest rates than the US, and our real estate is 8.9% of the GDP in Canada, while in the US, even during the housing bubble, real estate was 6.9% of the economy. Canada is more sensitive because of the real estate, as I mentioned, the mortgages, but also because Canadians have a lot more personal debt and did not deleverage in 2008 like the Americans did. The household savings rate for Canadians in Q3 was reported as 5.7%, which is below the rate prior to the pandemic, which means households are dipping into their savings and probably due to the inflation we've been seeing. This week, Royal Bank of Canada, Canada's biggest bank, announced that it will acquire HSBC Canada, which is Canada's seventh largest bank, which is the Canadian operations of HSBC Group, for 13.5 billion in cash. The price had come up from the fair value of 8 to 10 billion, so RBC definitely paid the full price and more. HSBC has been selling off some of its other foreign units over the years, and it was known that HSBC Canada was on the block. It's clear that a domestic Canadian bank would be a more cost efficient owner of this franchise, given clear opportunities for cost cutting. This is going to be the biggest deal between two Canadian banks ever and the first big bank merger in a decade. The deal would give RBC 130 more branches and 780,000 more customers. It still has to make it through the regulators, however, since RBC will be going from 24% of Canadian assets to 26%, further increasing concentration in the Canadian bank oligopoly. RBC is just acquiring the Canadian asset. They're not really expanding their global presence per se. They'll be getting some improvements to maybe things like trade finance products. There's a couple of other products, or maybe they'll be able to incorporate some of those HSBC advantages. But on the whole, they're not really creating a global presence or a global network as one would hope. The Canadian stock market, because of our energy sector, is looking better than the US so far because of the strong performance in that area. Energy stocks have had quite the run over the last 2 years, the best of any sector ever recorded back to 1962. That alone shifts the odds of continued outperformance, but it's hard to ignore energy's defensive qualities when you look through history. And the Canadian Big Six banks reported this week. The main indicators of bank performance are credit quality and net interest margin. Asset quality and collateral is in focus. BNS, RBC, and National Bank of Canada reported and were widely in line with expectations, but the market left them flat or down somewhat on the earnings report. BMO and CIBC came in under expectations, while TD exceeded them. RBC was the best, CIBC was the worst. The banks did benefit from higher interest rates as shown by a higher interest income and higher interest margin. The banks all left additional bad loan provisions, leaving extra money aside out of their profits. If the bad loans don't occur, those provisions will be added back to profits in the future. All the banks seem to be positioning for a deteriorating economic picture in Canada. On Friday was the big jobs report on both sides of the border for November. In Canada, the payroll employment was higher than expected, and the unemployment rate was 5.1%, lower than expected, and also coming down from October. Turning to the US, the jobs numbers were also very positive on Friday. The year-over-year wages increased 5.1%, higher than the previous month and higher than the 4.6% increase that was expected. So inflation is alive and well in the job place in the US. The payroll employment numbers grew more than expected, with the unemployment rate staying at 3.7% as expected and the same as the previous month. The economy isn't slowing, and unemployment still isn't coming up, which could encourage further interest rate hikes on both sides of the border. On Wednesday, the US Fed Chair Jerome Powell's comments about the central bank moving to slow its pace of rate hikes was enough to give the markets a leg up. Powell said, quote, "I don't want to over-tighten," end quote. This is news. To this point, the Fed has told us they would err on the side of over-tightening. Powell also said it's, quote, "not appropriate to execute some shock and awe strategy to crash the economy and clean up afterwards," end quote. The US Fed is starting to soften its stance on interest rate hikes. It's not a pivot to lowering rates, but moving towards a plateau. It is also increasing the risk of inflation not being brought back down to 2%. The US Black Friday sales exceeded $9 billion for the first time at $9.12 billion. US consumers are using the buy now, pay later, especially credit cards, and not tightening their belts in Christmas buying. They may tighten their belts in January, by which time the credit companies will be charging the high interest. The last rate decision of the US for the year is December 14th. After 4 straight 3/4 percentage point increases to tame high inflation, many expect a smaller 0.5% percentage point increase at the Fed's meeting next month. A pause in rate hikes or a pivot would likely send the markets higher. A higher terminal rate than previously, in excess of 5%, is now expected. The market may not care so much about the terminal rate as it does about having certainty that we have reached it, and that rates won't increase anymore. Third quarter US GDP was revised to 2.9% versus the prior 2.6% this week, which is a healthy growth and a reason for higher rates in the US. A US recession is still expected next spring and summer, and the markets will recover before the US economy does, as always. A mild to medium US recession is already baked into the market, in my opinion. The Fed needs the economy to be bad to lower demand and inflation, but the economy is staying resilient. A recession is a foregone conclusion in Europe, however. There is a question of the US rail strike. If it happens and goes over a week, all economic sectors will be impacted. On Wednesday, the House approved a tentative labor agreement between railroads and the workers' unions in an effort to avert a widespread and costly strike. In a 290 to 137 vote, the House approved new contracts for rail workers that include 24% pay raises over 5 years, as payouts averaging $11,000 and an extra paid day off. The Senate on Thursday passed legislation to enforce a railroad labor agreement, sending the bill to the President Joe Biden for signing ahead of a strike deadline. The agreement grants rail workers pay raises, one-time payout, and one additional paid day off, as I mentioned. In the US on Wednesday, private payrolls climbed by only 127,000 in November, far below the estimates, said ADP. This can be seen as the beginning of labor market slowdowns, as we've anecdotally seen, and another reason why the US Fed may not raise rates quite as quickly. And now we have some bits and pieces. Following the mass demonstrations across the country, Chinese authorities relaxed some COVID rules on Monday, but maintained Beijing's zero COVID strategy. Hundreds of people took to the streets in major cities, including Beijing and Shanghai, over the weekend, protesting widespread lockdowns in response to a record high outbreak, which has exaggerated global supply chain concerns. Protests in the key iPhone manufacturing city of Zhengzhou could result in a production shortfall of around 6 million iPhone Pro units this year. China's COVID zero policies are also weighing on global energy demand and have dropped oil prices early in the week. The protests against China's zero COVID policy would impact US domestic spending, but their effect on the US economy may be weaker as US demand softens. The unrest in China will dilute the recovery expected next year. The Chinese government could solve this by cracking down, which wouldn't be good for anyone, or by bringing in Western vaccines, which would still take 6 months from the date of the decision. By midweek, calm and peace had returned, but keep in mind that Xi Jinping's hold on power is very secure. The zero COVID policy is his baby, and he needs to look that he's right about it. As the electric vehicle market gets more crowded, Tesla's dominance in the US is eroding. The company's cars accounted for 65% of new registered electric vehicles through the third quarter, down from 71% last year and 79% of registered electric vehicles in 2020, according to S&P Global Mobility. By 2025, the firm forecasts that the figure will drop to less than 20%. And finally, turning to next week, we have companies reporting for the end of Q3. On Tuesday, we have Toll Brothers, which is bellwether on US real estate. On Wednesday, we have Dollarama, which is an indicator of consumer spending. Thursday is Costco for the US consumer spending. And we have Lululemon, Canada's darling. Economic events next week include on Wednesday, Bank of Canada's interest rate decision is coming, where we are at 3.75% and a 0.5% rate hike is expected, with perhaps a pause afterwards, as well as US oil inventories on Wednesday, which will affect oil prices. On Friday, we have the US Producer Price Index, an indicator for inflation. That concludes my thoughts for the week. If you have any requests on what you'd like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.